Welcome back to International Finance. I am Andy Kim, your Dr. Finance, and this time we are going to talk about Chapter 7 of Eun, Resnick, and Chulun, which is Futures and Options on Foreign Exchange. Now, what is this chapter about? Well, it's about financial risk management and financial engineering, 금융공학, right? The word that is kind of spooky to you, I guess, if you are not engineering majors. But risk management is about hedging your risk. What risk? FX risk. Imagine yourself as the CFO of Hyundai Motors, right? They sell a lot of electric cars like Ioniq. It's a smash hit product. So that let's say they sell 10 millions of Ioniq to US market this year. Okay? Party time, you'll be happy, right? Is that it? Not really. You will be worried about certain situation. What can wake you up in the middle of night? Well, what if the US dollar value plunges, right? You sold a lot of cars in US dollar terms. What if the US dollar value plunges down like crazy? Well, can you secure yourself, right, your company, from that kind of FX risk? There comes options for you, like an insurance or something. Okay? So put options or call options can get handy and you need it. And then for that purpose, you need to understand the underlying asset upon which these call options and put options are, structured. Those underlying assets, well, usually in FX, the futures contracts will be the underlying asset for these call options and put options. Of course, you can structure your call options and put options based on the spot market FX, but futures is much more prevalent. And then futures versus forward, what is the difference? We're going to talk about it here in this chapter, but this is much more standardized. Okay, the units of trading, right? One contract size is fixed, and then the maturity is fixed, so that anybody can buy and sell in an exchange. Whereas forward, it's not that much standardized, so that you, if you want to sell your contract to other persons, right, a third party, they will be like, hey, this is not what I meant to buy, or something like that, right? Difficult to find anybody that can purchase your contract itself. Whereas futures, it is easy to find. The market is much more liquid, so that's why the options are much more based on this futures market. That's the thing. So we're going to go through the understanding of futures in this video, and then the next video we're going to talk about the options market basics, and then we're going to spend another video on the economic basics and the mathematical basics of options. And why? Well, Chapter 7 is perhaps the most mathematically involved chapter throughout this book. Okay, so we need to get back to our basic understanding of mathematics as well as economics, about risk neutrality and then risk aversion, the utility difference, and then all these kind of things. We're going to briefly mention that thing, okay? Refresh those memories in the third video. And then we'll move down to option pricing techniques, right? Like binomial option pricing and risk neutral pricing, and then Black-Scholes model kind of things, right? So get ready for those, right? So let's go. Chapter 7, futures. So these are the things we're going to go through. Futures contract, preliminaries, and currency futures market. These two, and then the basic currency futures relationships. We're going to talk about it in this video, and then move down to options contract, preliminaries, and currency options market, currency futures options, and the basic option pricing relationships at expiry. Those are pretty much what we're going to talk about in the next video. American option pricing relations, European option pricing relations, binomial option pricing models, European option and empirical test of currency option models, all these kind of things in the following videos, right? Futures contracts, right? The futures contract is like a forward contract in that it specifies that a certain currency will be exchanged for another at specified time in the future at prices specified today. Now, a futures contract is different from forward contract in that futures are standardized. Okay? Why standardized? Because you want a third party, many third party buyers to be able to buy and sell very quickly in millisecond speed. Okay? If it is not standardized, they will have a hard time, or you will also have a hard time. Okay? They will have a hard time understanding what this contract is about. Okay? What's the maturity? And what's the size of it, and all these kind of things, right? The structural differences you'll have to figure out. They will have to figure out, and you will have to have a hard time selling those things to the other outsiders, right? So in futures, no problem. Everybody understands about this standardized feature so that you can buy and sell very quickly. And the contracts trading on organized exchanges, right? In forward, it's OTC, over-the-counter market. You can make a forward contract with your friends or anybody, right? Over-the-counter, which means like could be a private transaction between any parties involved, right? But here in futures, we have a clearing house, right? And then it's traded in organized exchanges, right? 선물 거래소. 거래소 exchanges in Korean terminology. Now with daily resettlement through a clearing house. So if there's not enough of a margin, daily basis they calculate those. We call it mark to market. Okay, daily prices, the settlement price or finishing price in the market for every trading day. We get that, and then look at your balance of the margin, okay? So that if you don't have enough of margin, okay, then the brokerage or the investment bank will call you. We call it margin call. Recently, in the stock market in the US, right, like over the last weekend, there was in 2021, right, end of March, there was a big news about the margin calls associated with a Korean American guy called Bill Hwang, right? And that kind of margin call situation can happen any futures market as well. So so that's something you can think about over here and then worry about. Anyway, now standardizing features, contract size is standardized, and then delivery month, right? Maturity. 1 month, 3 months, 6 months, 9 months, right? 3, 6, 9, 3, 6. And daily resettlement is a feature, right? Every day you have to make sure you have enough balance over there as a performance bond or something like that. 2%, right? By the way, initial performance bond, about 2% of contract value. Cash or T-bills could be there. Okay, cash. Yeah, of course, cash, no problem. Why T-bills? Because that's risk-free. You can easily, convert it into cash later on. So they accept T-bills as well. Held in a street name as your brokerage, right? The bank's name, right? And then currency futures market, the CME Group is the biggest one. Chicago Mercantile Exchange, right? Chicago Mercantile Exchange is by far the largest currency futures market. You can click it and then see it. Yeah. There. What is this? Yeah. There we go. CME Group is there. And then you can pretty much play, okay, and then explore this website and learn about what this mercantile exchange is about, right? And then they provide different language-based websites these days, okay? In fact, I was the first website that I was able to go when I Google searched it was totally Korean written, and I was very surprised to see that. Anyway, markets, and then data you can get, and then services, all these kind of things. They have some education program over there, Yeah, so you can learn a lot from there. Anyway, Chicago Mercantile Exchange or CME Group, well, it's a building over here, and then the inside looks like that. Yeah, the CME Group, yeah, I told you. And then the Singapore Exchange offers interchangeable contract. Well, when it comes to Asian market, right? SGX is over there. There are other markets, but none are close to CME and CIMEX trading volume, in terms of trading volume. And then me and the Global Business Administration students, we all visited SGX, Singapore Exchange before, and then we had in-depth discussion about the summary of in-depth discussion about this futures market and then what they do, okay, in Singapore. Basically, they're doing all this kind of capital raising and then the trading for Asian market, right, including all different countries and then involving all different countries. Now, Korea also has futures exchange or exchange derivatives market, Korea Exchange, right? So you can click it and then explore their website like this. All right, Korea Exchange renewed. You see KRX, right? And then for language, you can try different languages, and then you can see some market data, right, as well as products, all these kind of, and then commodities, and then derivatives and indices and market news. You can explore this site and then go ahead and play yourself, right? And then currency derivatives. Wait, come on, over here, currency derivatives, US dollar futures, all this kind of information you can get. And then market data is also there, and then derivatives, commodities, and then right, futures and options in right, and options current price, and then gold market, all this kind of commodity related information is also there. And then yeah, so that's basically what you can explore throughout this website. And expiry cycle, typically, yeah, 3, 6, 9, December, the multiple of 3s, right? Don't ask me why it is 3 months based, right? I don't know, but it's just convention. And then the delivery date is the 3rd Wednesday of delivery month, right? Why Wednesday? I don't know. But it's just industry convention, right? The last trading day is the 2nd business day preceding the delivery date. Okay, so that's that. Now, Exhibit 7.3 shows the currency futures contract quotations, right? Here I am getting this, I am showing you this table of 7.3 from the previous version of the textbook, 8th edition, because 9th edition's JPEG file is not that accurate to see, right, over here. The precision of the shape is not that good. So I'm just showing you over here as a demonstration purpose. And then you see what? Here, let's go one by one. From the in the vertical axis, what you see is a different currency futures contract, right, shown. And the first thing you see is Japanese yen, okay, and you see there is a fixed trade size per contract, right, trade size. The basic unit is 12.5 million Japanese yen worth, right? And then exchanging into dollars, right? And then dollar per 100 yen figures are shown over here, right? As opposed to euro or other Australian dollars, right? The Japanese yen is denominated in such a way that you have to use dollar per 100 yen. Okay, that's the industry convention. What about Korean won? Well, 10 times Japanese yen. So 1,000 Korean won versus $1 kind of convention is going on, right? Currency denomination matters over there, but the industry convention works like this, okay? Now, per contract, right? It works like this. Canadian dollar is 1 for 1, right? Dollar per Canadian dollar. And then the unit is 100 million Canadian dollars worth. What about British pound? That's 62.5 thousand pound unit. Why is it so? I don't know. Just it's industry convention. And dollar per pound unit is shown over here, right? And then Swiss franc, the unit is 125,000 Swiss franc unit. And then Australian dollar, right? 100,000 Australian dollar unit. And then Mexican peso, 500,000 Mexican peso unit. And then euro, 125,000 euro. Now, euro to Japanese yen cross futures rates are shown over here. Okay, that's 125 euro. Okay, unit. And interestingly, this is yen per dollars, yen per euros, right? Sorry. And then euro British pound, right? Cross futures rates are shown over here. Okay, futures price is over here. 125,000 euro unit commonly across like this, and Swiss franc to a euro to Swiss franc rate is shown over here. And then what you see is the opening price and high price, low price, and settled price. What are those? Well, last year, like I had a hard time, not understanding, but telling this to the students who are not experienced with the stock market. But these days, thanks to the intensive day trading by everybody, right, including the guys who are trading in Robinhood, right? Now you understand how the price works. Daily, every millisecond the price changes, right? So what was the opening price in the trading day? What was the high price, maximum? What was the minimum during the day, intraday bound, right? And then the settlement is the end of the trading day, the final price, okay, is shown over here, futures price, okay? And then what you see is a change, okay, over here. That's the since last day, okay, end of the day, and then yesterday's settlement price to today's settlement price. The change is shown over here, all right? And then open interest, this is the number of contracts outstanding for a particular delivery month. It is a good proxy for a demand for contract. And then how many contracts? Well, for Japanese yen to US dollar, right? For June, right, in 2016 maturing, they had 159,608 contracts open, right? That's 1 month from then, right? And then this is what? Almost 4 months ahead. And you see a clear pattern that the longer away from today, then you see less of a open interest. More closer from today, you see many more contracts going on. Why is that so? Well, it shows the demand in the market. They want to make a lot more transaction about doing futures contract for short-term maturity than long-term maturity. I mean, naturally, short-term, longer term is much more risky and there's a lot more uncertainty going on. So people will be less likely to make a futures contract and bet on it. But for shorter term, well, it's less of an uncertainty. So it's much more demand going on in the market. Notice that open interest is greatest in the nearby contract like that. Okay, you see clear pattern going on. Now, moving down, daily settlement, resettlement. Okay, with futures contracts, we have daily resettlement of gains and losses rather than one big settlement at maturity. right? Forward contract, you have no legal enforcement like that. Making your forward contract with your friends, and then do you daily call up the guy and say, you know, are you sure you will be able to, you know, finish this transaction like 3 months from now or 3 years from now? Do you call up that guy every day simply because the price moved? No. Okay. You take that risk until the end. Okay, and then get screwed maybe. Okay, that's risky. But in the futures, right? Futures, the organized exchange works for you, right? To secure everything like that. Okay. Every trading day, if the price goes down, the long pays the short. It's a zero-sum game. If the price goes up, the short pays the long. And after daily resettlement, each party has a new contract at the new price with 1 day shorter maturity. All right. So the consider long position in CME British Pound futures contract. It is written on 62.5 thousand pounds, and the price is quoted in dollars and cents per pound out of 4 decimal points. Okay, 4 decimal points. Some of you may question, right, in your exam setting, whenever do your exam, how many numbers below decimal point do I need to show? Well, 4 digits below decimal points, right? It's convention over here, right? Just follow it. So you have to round it up at the 5th number, right, below decimal points, right? The minimum price increment is 0.0001, okay, dollar per British pound, or 0.01 cent, right, per British pound, which corresponds to 6.25 dollars per contract, because this is just a multiplication of these two, right? We went long the futures contract at a price of 1.3 dollars per pound. Okay, futures contract, and then 1.3 dollars per pound. At initiation of the contract, the long position posts an initial performance bond of $16.25. How do we come up with this number? I told you 2% rule times 1.3, okay, dollars per pound, the futures contract price, right? Rate, right? And then this is the unit, so to 62.5 thousand pound. So pound times dollar per pound, and then 2% of it should be secured as a performance bond. The maintenance, right? Maintenance performance bond is, by the way, the maintenance performance bond is 1,300 US dollars, right, for this British pound contract. So initial contract, right, performance bond is above this maintenance performance. Like maintenance gives us an idea about the minimum balance that you can think about, right? Minimum balance, but the starting balance would have to be sufficient, right? So you have some buffer over there, $325 buffer. Okay, now let's see. Each day, right? Each day's losses are subtracted from the investor's account by the clearinghouse. Each day's gains are added to the account, right? It's zero-sum game. And then in this example, on initiation, at initiation, the long posts an initial performance bond of $1,625. The maintenance level is $1,300. So if this investor loses more than $325, he has a decision to make, right? He can maintain his long position only by adding more funds. And if he fails to do so, his position will be closed out with an offsetting short position. Okay, so can you afford it? Okay, going into the future, right? That is the question over there. So once you set up this, enter into this futures contracts through the open exchange, right? Like that. Let's see what happens over the first 3 days. The pound strengthens for the next day, and then depreciates. Appreciates in the first day and depreciates to the next 2 consecutive days. All right. So then see what happens to your account balance, right? Your performance bond, right? Would you get a margin call? 감당하실 수 있겠습니까? Kind of thing, right? So the first day, right? Okay, the next day, right? Let's say the settlement price became $1.301 per pound. Okay, pound appreciated. Then what happens to your gain versus loss, right? Your gain will be 1.301 minus 1.3. That is $0.001 per pound, which is 1 cent per pound. For each pound, you have 1 cent gain, which is multiplying by the basic unit of this contract, 62.5 thousand. You will get plus $62.5 of gain. Now, remember, you started with initial account balance of 1625 before, right? In day 0. Now, you add this $62.5 to your balance. In the end, you will get $1687.5 in your account balance, right? Remember, your minimum balance has to be $1,300 for each contract over there. So would you get a margin call? No way, far from it, okay? You'll be happy, yeah, but the next day, the pound depreciated, okay, in the futures market, so that is $1.298 per pound, okay? Then what happens to your gain and loss in your futures contract? That's minus $187.5 per contract. Why is this the case? Well, if you do the number, you will realize that it is 1.301 minus 1.298, because this is calculating day by day gain or loss. So starting from yesterday's amount and how much did I gain or lose is the concern over here. Okay, and then times this number 62,500, right? Then you will get minus $187.5 per contract. So what do? Well, starting from 1687.5 minus 187.5, that you will get $1,500. Make sense? Right. So that's your account balance. Would you get a margin call? Remember that was 1,300? Far from it yet. Okay, fine. The following day, let's say the pound depreciated to $1.2948 per pound in the futures market. What happens to your gain or loss? Well, starting from yesterday, 1.298 minus 1.2948. Is that right? Yeah. So the difference times the unit, which is 62,500 pound, then you will get minus 200. Okay, minus 200. Then what happens to your account balance? Well, subtract 200 from yesterday's account balance, which is 1,300. Ding, 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 ding. Your margin call rings. It rings your bell. You can ring my bell. Ring my bell. Yeah, that's not a pleasant bell, right? And margin call happens. Okay. So you will have to decide whether you will stay with it or not. And at the end of this adventure, we have 3 ways of computing gains and losses. 1 to 3 different ways. You will end up with the same number of 325 gains and losses, right? Over here. Let's see. Right. On day 3, we receive a margin call having lost 325, right? And then losing 325. How do we come up with this number? Well, you do this number and you will realize there's a typo. Minus 325 is nothing but the sum of daily gains and losses. Day by day, gain or loss, add it up. You will get 325. This guy minus that, those two guys, right? 325. Second way of doing it is contract size times the difference between the initial contract price and last settlement price. Remember, it was day by day. Cumulatively, you've been doing the calculation so that in the middle process will cancel each other out, so that what you need is your initial contract price versus the final settlement price. Bang. And then you get this 325. The third way of doing it is ending balance on the account minus the beginning balance on the account, just for deposits or withdrawals. So 1300 minus 1625. Initial balance and then ending balance. This is your loss, right? So that's how we calculate all these things. So in currency options, we've been going through this industry conventions, a lot of it. The concern is more about, how much of a margin amount, right, do you need in the performance bond, right, was a concern. Next video, we're going to talk about options market, okay? So I hope you liked my presentation today, and then like and subscribe. Thank you for watching. All right, see you. Bye-bye.